Chapter 9, Tax Credits. Learning Objective 1, Credit for Child and Dependent Care Expenses. Similar to how we saw the government incentivize home ownership with the mortgage interest deduction, here we can see the government's going to incentivize working families having participation in the labor force. And they're going to do this by allowing a credit for those expenses paid to bring something like a nanny into the house or for a daycare expense. The idea being that by paying those expenses, you're going to free up time of the taxpayers to be able to go out into the workforce. So the first thing we're going to want to look at is what are the qualifying individuals that we can pay these services for. So the first is going to be a person under the age of 13. So essentially, for whom the taxpayer is entitled to a dependency deduction. So essentially, we're talking about a child here that's not in middle school or not in high school or older. And the second is going to be a dependent or spouse of the taxpayer who's incapable of caring for themselves. And what we're thinking about there might be for a parent that's in the taxpayer's residence that they're caring for, or maybe a spouse that's not able to be cared. Kind of the same thing of freeing up your time to go out into the labor force by paying an expense to have someone else provide that care. So how do we calculate this credit? So the first thing we're going to want to take a look at is what is the percentage that's going to apply to those qualifying expenses. And here we'll see a table in the advanced slide that's going to lay out the percentage that's going to be between 35% and 20%. So if we are going to be under the initial threshold, we're going to be able to take 35% multiplied by those qualifying expenses. That's going to be limited. And if we earn the higher amount for the AGI, so an amount over, say, $43,000, then we're going to be limited to just 20% of that limited qualifying expenses. So what's going to limit them? So the amount of expenses that we pay for one of these individuals is going to be $3,000. And then if we have a second or more qualifying individual, we're going to be able to double it to $6,000. So there's only one or two options here for the initial limitation. It's either going to be $3,000 if there's one qualifying individual, or else $6,000 if there's more than one qualifying individual. And then we're going to take the amount of expenses after being limited multiplied by that percentage. And we'll see some examples that walk through how we do that. So this isn't the only limitation that we have on those qualifying expenses. The other is going to be that the amount of earnings that we have needs to exceed the expenses. So this has to be a good economic decision that we're making here, to where we're earning more in the workforce than we are paying to have those qualified expenses to care for the individual. So what we're going to do is deem that whoever earns the smaller amount out of joint taxpayers is going to be the one that we're talking about here. If we're single, then the taxpayer's own earnings are going to be what's used for this test. So if we had one qualifying individual for a married couple, and then the lower of the two had only earned $2,500 for the year, we're not going to get the full $3,000 limitation for the qualified expenses. We'd only get $2,500, so we get a lesser amount that we can use in this tax credit calculation. Now, if one of the spouses is not earning but is a full-time student, then we can deem them to have income. And the amount we're deeming if we were a full-time student for the entire 12 months is going to be $250 per month. So that math will get us to $3,000 for one qualifying individual, or $500 per month for two qualifying individuals to get us to $6,000. The only issue that's going to come into play here is many full-time students don't actually go to school during the summer months. So if you're not in the workforce earning money over that summer period, you may end up at an amount less than $3,000 for one individual, or an amount less than $6,000 for two. So here's the table that I referenced earlier that shows that if we're at $15,000 or less, then the percentage we're going to use is 35%, and that we are, if we are over $43,000, then the amount we're going to use is 20%, and you can see the declination the percentage as we go from that 15,000 to the 43,000. So let's take a look at our first concept check. Here, Jamie is a single mother with one dependent child, Joey. who's under the age of 13 at age 7, so they are going to qualify. The adjusted gross income is 75,000, so we're going to be over the 43,000, looking at 20% for the amount of our percentage. And we paid 4,500 for the qualifying daycare, but we're going to be limited to 3,000 for the amount of expenses we can claim. So the way we'd calculate that is we take our limited qualified expenses at 3,000 multiplied by our percentage at 20%, and we'd get 600 for the child and dependent care credit. Concept check 2. We've got Tom and Katie are going to be married, filing a joint return, have 2 dependent children, Jack and Jill, age 11, age 5, so both under 13. So both will count. Tom has an earned income of 41,000. Katie is going to be a full-time student with no income, so she's going to be the one that we're going to use for her earnings to see if we're limited. As a full-time student, we're going to be able to deem her as having income with 2 children of 500 per month, but she did not work in the summer, so we're only going to use 9 months for that amount. So even though we paid qualified daycare expenses of 6,000, the amount that we can use in that calculation is just going to be the 4,500 for the $500 deemed earnings times the 9 months that she was a full-time student. Concept check 3. Antonio is a widower and cares for his son Elio. Antonio has an AGI of 24,000 and paid qualified child care expenses of 2,900. In addition, Antonio received 1,000 of dependent care assistance from his employer, which was excluded from that income amount. So here we cannot use the full 2,900 that was paid. 1,000 was paid from that amount that was set aside. So we're going to have to take that away and only use the 1,900 for qualified expenses that Antonio would have paid after employer assistance was factored in. We're going to look at that chart and see that 24,000 in AGI is going to correspond to 30% for the percentage. So we'd multiply 1,900 times 30% to get $570 as our child and dependent care credit. Learning objective 2. Credit for the elderly or the disabled. So there's a credit that's going to be available for taxpayers over 65 or those permanently and totally disabled, which is going to be calculated by taking 15% times an allowable base. And we'll take a look at how you do that calculation, but it's important to set out that this credit's not going to be something that's fairly prolific, and part of the reason for that is that base amount is going to get reduced by non-taxable Social Security, and individuals that are either taxpayers over 65 or are permanently and totally disabled are often going to have some of this non-taxable Social Security that will end up reducing that base amount. We'll take a look at how that is calculated. First, the base amounts are going to be $5,000 for single taxpayers and $7,500 for those filing a joint return. Now, if you're married filing single, you essentially get half of the joint return, so $3,750. And again, this amount's going to be reduced by one of two ways. Either we're going to reduce it by the amount of non-taxable Social Security, or 1/2 of your adjusted gross income over a threshold amount. So $7,500 for single or $10,000 for joint filers. So if we were single and had $3,000 in non-taxable Social Security and had earned $10,000, we would take our difference between $10,000 and the $7,500 and get $2,500. We'd divide that in 2 to get $1,250. So we would subtract $3,000 and $1,250, or $4,250 away from $5,000 first. So we'd only have $750 for our base that would apply here. We'll take a look at an example of how that's going to play out. So here, Joe and Sue are married, file a joint return. They're 70 and 60 respectively. They have AGI of 12,000 and receive non-taxable Social Security benefits of 1,500. So here they're going to take that base amount of 5,000. We're going to reduce it by the 1,500 of non-taxable Social Security they received, and then also the amount over 10,000, which is the threshold for the married filing jointly. They were 12,000 for AGI, so 2,000 over. Half of that would be 1,000. So we're going to take 1,000 and 1,500 both away from the 5,000 to get 2,500 for the allowable base amount before we multiplied that amount by 15% to get 375 for the credit. So let's take a look at concept check here. Vincent and Maria are ages 70 and 67 respectively and file a joint return. They have an AGI of 21,000 and received 1,000 in non-taxable Social Security. Calculate Vincent and Maria's credit for the elderly or disabled. So first, we're going to want to take that base amount of 7,500. And here, they're both going to be included in the amount for the base amount because they're both going to be meet the age test. So we're going to have 7,500 for that base amount. We're going to first have to subtract the 1,000 for non-taxable Social Security, and then we're going to calculate the amount we're going to take away from based on their income. So 21,000 minus 10,000 will give us 11,000. Divided by 2 is 5,500. So we're going to take 6,500 all told away from the 7,500 base to get 1,000 for the allowable base amount. Multiplied by 15% would only be a $150 credit here. Learning objective 3, education credits. So there's going to be 2 education credits we're going to look at: the HOPE credit, or the American Opportunity Tax Credit, and then the lifetime learning credit. It's important to note we can only use, we have to pick between the two. We can only use one of those, and the American Opportunity Credit is going to be, there's going to be 2 different tests essentially for these. The American Opportunity Credit is only available for the first 4 years of study, whereas the Lifetime Learning Credit can be after that amount. So what's going to qualify as expenses? It's going to be the amount paid for tuition, fees, and books. It says with certain criteria met here. Essentially, these are going to be have to be required and, by the institution and typically paid through the institution. So if you go to the campus bookstore and are buying a book that is required for the course, and you wouldn't be able to complete the course without the book, then we're still going to qualify. That's still going to be included in a qualifying expense. If instead you went to Amazon and got an additional supplemental book or material or study aid that's not really required for the course, but you feel would be helpful, then that amount is not going to be a qualifying expense. It's important also to note here for the qualifying expense that we're excluding room and board as well. So this is just going to be tuition, fees, and those required books. So how do we do the calculation? So 2,500 is going to be our HOPE credit amount, and that's going to be the first $2,000 spent, or we're going to get to count every dollar of that, and then 25% of the next 2,000. So for every $4 we spend after 2,000, we're going to get to claim 1,000 towards that credit. The lifetime learning credit is going to cap out at 2,000, but it's going to be 20% of every dollar. So every time we spend $5, we're able to count $1 towards this lifetime learning credit. Again, we cannot use both credits in the same on the same tax filing, so we have to pick which one that we're going to use. And the American Opportunity Tax Credit is only going to be available for those first 4 years. Both of these are also going to phase out at a certain threshold. So the HOPE credit is going to be 90,000 is going to completely phase out if you're single, 180,000 if you're married, filing jointly. And there's a $10,000 range in which this thing is going to get phased out. So between 80,000 is when the phase out is going to begin, and 90,000 when it's going to be completely phased out. We're doubling that to 160,000 and 180 for married filing jointly. Now for the lifetime learning credit, we're going to have the same 10,000 phase out range for single filers and 20,000 phase out range for married filing jointly. But we're going to start that at 58,000 for single filers, and it's going to get completely phased out at 68,000. And for married filing jointly, 116,000 that'll completely get phased out at 136,000. We can take a look at those formulas in terms of how we do the calculation. So we're just going to get a percentage. So if you were at 85,000, for example, for a single taxpayer here, then you would be halfway through that $10,000 range, so 50% of the credit. And then similar formula and calculation for the lifetime learning credit. So let's take a look at a concept check. So here, concept check 1, Jules is a single taxpayer and paid $2,900 in qualifying expenses for her dependent daughter. who attended the University of Arizona full-time as a freshman. How much is the lifetime learning credit without regard to those AGI limitations? So those might be limited if she earned over $58,000. Here we're going to assume that that's not the case and she's going to get the full amount. But we're going to take 2,900, which is an amount under 10,000, multiplied by 20%, so 1 of every $5, and 580 is going to be the amount that she can use towards that lifetime learning credit. Concept check 2. We're going to assume the same facts, but we're going to give her a modified AGI of 85,000. And she wants to claim the American Opportunity Tax Credit. We want to know what the amount allowable credit after the credit phase out would be based on her AGIs taken into account. So here she's going to get 100% of the first 2,000, 25% of the second 900 for a maximum credit of 2225. However, earning 85,000, she's going to be halfway between that AGI phase out. So she's only going to get 11,000. So she's only going to get so we don't have the answer popping up here. Doesn't look here. She would only get half of the amount for the AGI. So she would get $11,012, $11,1250 would be the calculation for half of that amount. So concept check 3, we're going to assume the same facts, but we're going to change her modified AGI, and she still wants to claim that same credit. So what's the allowable credit after the credit phase out here? Here she's going to be over the 90,000, so sure, phase out is going to be maxed out to where she's going to get none of that credit. So she wouldn't be able to claim the credit with 98,000 of AGI. With an 85,000 AGI, she would be halfway through that phase out range and get to claim half of the 2225 amount that would be the qualifying expenses. Concept check 4. Vern and Whitney paid $1,600 and $2,100 in qualifying expenses for their twin daughters to attend a nursing program without regard to the modified AGI limitations. How much is their lifetime learning credit? So here we're going to be $3,700, which is under 10,000. So we can use that full amount multiplied by the 20% to get $740, which would be the maximum lifetime learning credit that they can use, assuming that they're not in that phase out range. Learning objective 4, foreign tax credit. So for most individuals that are taxpayers in the United States, they earn their income in the United States. So this foreign tax credit is not going to be an issue. But for those individuals that have income that's earned abroad and they pay taxes abroad, it's going to feel like double taxation if they pay tax on that income in the United States, as well as paying tax on that income in the foreign country in which it was earned. And part of where this comes from is the fact that we have a worldwide tax system. So it's not that amount that is earned abroad isn't excluded from your income. It's going to be something that you report as income, and then a tax amount that is going to get applied to it. So what we're going to do first, when we're given a credit for the amount of tax, we're going to point out that the amount of the credit that you're going to get for it cannot be greater than the amount you actually pay, and cannot be greater than the proportion of it that you would have under this U.S. tax code. So let's take a look at how that calculation works. So if you had, you want to take the percentage of your worldwide income that is foreign sourced and multiply by your U.S. income tax amount before the foreign tax is applied. And that's going to be the amount attributable to that foreign tax. So an example here would be that if you had $100,000 of worldwide taxable income, 20% is going to be foreign sourced. So you're going to have 20% of that income being foreign sourced. If your U.S. tax would be $30,000, then you're going to take 20% times the $30,000 to get $6,000, which is going to be the U.S. income tax attributable to that foreign tax. So we're going to cap the amount that you can claim for the tax credit by either the amount you paid and the amount that would be attributable. So if you paid more than $6,000 in foreign taxes, you can only claim $6,000 as that amount. If, in contrast, you had paid $4,000 in foreign taxes, then $4,000 is going to be that amount. So the credit's going to be equal to the amount of taxes paid, but no greater than that amount. So it's going to have to be take a look at both how much is going to be the amount for your proportion, and then how much is the amount actually paid. So let's take a look at a concept check here. Joy has $63,000 worldwide income. It includes $8,000 of foreign income, and then she paid $2,500 in those foreign income taxes, and her U.S. tax liability is $17,640. So we're going to calculate that, and it says the amount is less than the foreign tax paid of $2,500. The credit's going to be equal to the $2,240. So the credit, learning objective 5, the child tax credit. So in addition to the credit for child and dependent care expenses that kind of incentivizes working families having participation in the labor force, here there's an incentive by the government just for families themselves. So to have a child, you get one of these partially refundable tax credits for $2,000 for each child, and there's some limitations here, some qualifications rather, in terms of the children need to be under age 17, they need to be U.S. citizen or resident, they need to be younger than the person claiming the credit, which is making sure that that it's essentially going to be a fair child tax credit here, that we're not going to have someone that's the example here would be if you're going off to college and maybe you adopted a sibling or something like that, to where that's going to be considered out of bounds for claiming the credit. That you if you have somebody that's going to be your child that you're claiming a child tax credit for, that you need the child needs to be younger than you and needs to be younger than 17. So the credit's also going to get phased out over an AGI amount, but that AGI amount got changed under the new tax law to where we're looking at about $400,000 for married filing jointly. So it's not going to be quite the same limitation as it previously was. And the refundable amount is not going to be the full $2,000. Only $1,400 is going to be refundable. So refundable again, being that if the amount that you would be able to get back as a tax refund. And then there's a $500 non-refundable credit for qualifying dependents other than children. So again, this is a situation to where we might have a parent that's going to qualify as a dependent in the household or something along those lines. So again, the phase out is going to begin for $400,000 for married filing jointly, $200,000 for all other taxpayers, and it's going to get reduced $50 for each $1,000 above that fraction. So the example here is the single taxpayer has $217,000 for the one qualifying child. The tax credit is only going to be $1,150, as we're going to take $17,000 times that $50 per $1,000. So we're going to end up with $850 for the amount that's going to get taken away from our $2,000 tax credit, leaving a difference of $1,150. Let's take a look at concept check 1. Pat and Lisa have 2 qualifying children, ages 11 and 8, and they file a joint return. Their AGI is going to be $112,000. What is the amount of the child tax credit that they can claim? So without considering limitations, the child tax credit is going to be $2,000 per child, or $4,000 in total. And then looking at the AGI limitation, here married filing jointly is going to be $400,000, so they're going to be under that limitation. So $4,000 would be the amount that they can claim for child tax credit. Concept check 2. Child tax credit cannot be taken for a dependent age 18. So that's going to be true. The child needs to be age 7. Credit is not permitted if the child is age 17 or greater. So you need to be under the age of 17. Concept check 3. Arthur is an unemployed widower in the U.S. Is a U.S. citizen, is unrelated to Fred and Marlene, has lived the entire year in their residence. Arthur is between jobs, and Fred and Marlene are paying all of his living expenses until he finds employment. Can Fred and Marlene claim a $500 credit for other dependents for Arthur? And then the answer here is going to be yes. Arthur meets all the requirements to be a qualifying relative. Learning objective 6, retirement savings contribution credit. So one of the things that the federal government incentivizes is savings. Here, there's an additional, in addition to the systems kind of set in place to incentivize folks that are working to save through, for example, like IRAs or 401ks, 403bs. There's an additional credit available for those that don't earn that much in terms of it to incentivize them to save more than they ordinarily would. So the maximum amount of contributions for credit purposes is going to be $2,000 per person, and it's going to be the credit's going to be based on the percentage of contributions made. So let's take a look at those, the amounts, and then what those would be. So here for joint filers, we're going to look at the initial amount being 50% for those that earn $38,500 jointly or less, and then it's going to be reduced to 20% over $38,500 to $41,500, and then reduced again to 10% for those over $41,500 to $64,000, and then reduced to 0 for those over $64,000. We've got a head of household amount that's going to follow a similar approach, and then we've got all others. So this would be single filers. For the single filers under or not over 19,250 would be your 50%, and similarly, and then over 32,000 would be reduced to 0%. So concept check 1. Here we have Enrique and Lupe have an AGI of 52,000, married, filing jointly, and contributed 1,500 during the year to qualify retirement plan for Enrique. How much is the retirement savings credit? We're going to take 1,500 for the contributed amount times 10% for the percentage calculation to get $150. Concept check 2. Roger's head of household with AGI 26,000, made 2,200 contributions. How much is the credit here? We're going to take 2,000 for the maximum amount that you can contribute or be considered to contribute times the 50%, which is going to be the percentage for that AGI to get 1,000. Learning objective 7, adoption credit. So there's a credit that's available for 100% of qualified adoptions paid. The credit's only available for $14,080 per child adopted. So this is over a span of time, not just in one year. And then if married, you generally need to be filing jointly to take advantage of that credit. There's also a phase out that's applied here. Here the range is going to be 40,000, so it'll go from 211,160 to 251,160. And then the percentage that you're in that amount will be used as that phase out. So taking a look at a concept check for how that's going to work. Adam and Michelle incurred the following expenses in their adoption, and it was finalized in 2019. So 2018 they had 10,500. 2019 they had 3,950. And if their 2019 modified AGI is 120,000, how much can they claim in 2018 and 2019? So in 2018 they wouldn't claim anything. However, in 2019, which is when the adoption was finalized, they can claim the 2018 amount plus the 2019 amount up to that 14,080 limit. So they can claim the maximum for the credit. So concept check 2, Zhang and Mika spent 16,000 in qualified expenses. The adoption was finalized and all the expenses were incurred in the current year. AGI was 236,000. So 16,000 is more than the maximum of 14,080. So 14,080 is what's being used here. And then we're also going to take a look at the phase out range. And then once we apply that income phase out for their $236,000 in income, we're going to get $5,336 for the amount. Learning Objective 8, Earned Income Credit. This credit is going to be available for working taxpayers that are economically disadvantaged, and this is going to be a refundable tax credit. So you're going to get this amount back even if you didn't pay taxes. And the incentive here is to compensate disadvantaged working taxpayers that may pay other taxes. For example, taxes that might be thought of as regressive, such as like a fuel tax, to where you're paying tax on the gasoline to work, but it's going to be felt less harshly by those that earn more. So this is the earned income credit is meant to kind of offset that. So to be eligible for the credit, you must either have a taxpayer either must have a qualifying child or meet a certain criteria as well. And then for the earned income, we're going to include wages, salaries, tips, and earnings from self-employment. And of course, we're going to minus off half of the self-employment taxes for that calculation. So the credit can be completely phased out at certain income levels, and then certain types of income, mostly investment income in excess of $3,500, will cause the taxpayer to become ineligible for the credit. Again, this is mostly to try to compensate or offset some of the regressive aspects of some of the taxes that are levied. So whereas some types of income, mostly investment income, might be thought of as folks that would have the means already. So it's not going to be as beneficial for them. So the maximum earned income credit amounts here is going to be, if you have one child, $3,526. If you have two children, $5,828. Three or more children, $6,557. If no children, you're still going to have a maximum earned income credit. It's going to be $529. So the amounts above, the above amounts are the maximum earned credit allowed. And then depending on earned income amounts, number of children and filing status, the amount will get phased out above those certain amounts. So let's take a look at a concept check here. So Josh and Daniel both work and have one qualifying child. They have earned income of $20,000, and using the earned income credit tables at the end of the chapter, that we can see $3,526 is going to be the amount for their earned income credit. Concept check 2, assume the same facts as above, except that their earned income is $32,000 instead of $20,000. Then we're going to have a $3,526 for the maximum credit they could get, but we're going to use that formula to take $32,000 minus $24,820, and then we're going to get $2,379 for the amount of earned income credit that they would get with that income. Concept check 3, Tiffany has had a household with 2 qualifying children. She had an earned income of $16,000. If she qualifies for the earned income credit, how much is her credit? And then if her tax liability is $800 for the tax year, what is the amount of her tax refund or tax owed after the earned income credit is taken into account? So she qualifies for $5,828. And then the earned income credit is a refundable credit, so a credit of $5,828. If she had tax liability of $800, she's going to get a net refund of the $5,828 credit that she would be owed, minus the $800 that she'd need to pay to satisfy that tax liability. So $5,028 would be the net refund. Learning objective 9, the premium tax credit. What this is in regards to is premium tax credits that can be taken at the time of filing, or spaced out during premium payments for health insurance purchased through the marketplace under the Affordable Care Act. So if you ordinarily would pay, say, $1,000 a month for health insurance through the marketplace, but are able to get a $500 a month credit for that amount, you can either pay the $1,000 up front and then get the credit later, or else use that tax credit in advance to pay those premium amounts. So you're only paying $500 out of pocket, and then the $500 premium tax credit is paid to satisfy the $1,000 full premium amount. And then upon filing, you're going to reconcile that amount. So we're going to take a look at the actual income and then the actual amounts paid to figure out what that premium tax credit should have been. And then if the premium tax credit is higher, then you'll get essentially a premium tax credit in addition to those already spaced out over the course of the tax year. Or if the amount of the premium tax credit would be less than the amount that was used to offset that premium, so that you may be paying the difference. So concept check 1 here, it says all taxpayers who have health insurance are eligible to receive the premium tax credit. That's going to be false. The credit is only available for taxpayers with household income between 100% and 400% of the federal poverty level. So this is something to help offset the cost of health insurance for those under that income threshold.